You're listening to Witham's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Witham's umbrella to better weather the storms of tending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Hello, everyone. We're excited to be with you today and continuing the Witham podcast surrounding the expiration of the Tax Cut and Jobs Act and potential policy that's being presented by both the Democratic and Republican candidates. So here we're sitting on the week that the vice presidents will have their debate. And we're rolling in quickly into October, obviously. And I'm pleased to be with Jonah Gruda today, who is a partner out of our New York City office, as well as Hal Terr, who is a partner out of our Princeton office. And so today's main focus, as we've been, cutting away each week by week, we started with the federal budget and why do taxes matter. We went more to what's happening in DC now. Where do we think we could end up this fall after November elections? Then we focused in on partnerships and flow through entities like S corporations and talked about some material changes that could be presented at the early of 2026 or end of 2025 sunsetting provisions. And today we're going to focus on individuals, and we're going to focus on individuals and high net worth planning and where it's adjusting to or could adjust to with the Tax Cut and Jobs Act expiring, as well as what policies we potentially are seeing or being proposed amongst the two presidential candidates. So again, I remind everyone, if you've listened to our podcast before, we always talk about the Tax Cut and Jobs Act that was passed in 2017 and the fact that it indeed has expiring provisions. So I like to remind all of our listeners that when we say a provision is expiring, if the Democrats do nothing and the Republicans do nothing, if there is a sweep or there's not a sweep come November, regardless, the Tax Cut and Jobs Act, there's significant law changes that will indeed expire or go away. We call them sunsetting provisions. And why that indeed took place is because the way the Tax Cut and Jobs Act was passed was through the budget reconciliation process. And so the budget reconciliation process essentially is common. Has been used by both parties, Democrat and Republicans, to pass specific law when they don't feel as though they can get a 60 person vote in the Senate in support of a bill. So what a budget reconciliation process allows you to do is it essentially allows you to push it through, the House and the Senate, and at the Senate only needing a simple majority vote of 51 in order to ultimately get on the president's desk. So what's interesting, every type of, judicial versus presidential versus congressional has kind of a responsibility in operating of the government. And the congressional responsibility is targeted to be fiscal, right? Making sure that they're overseeing the budget appropriately. And so through the budget reconciliation process, essentially what they do is they tie tax law to revenue, right? To revenue raisers or revenue declines based on tax law. But overall, they're really playing overall with the federal budget, right? And so with this simple majority vote at the Senate, what they were able to do is get a 10-year window period in which they agreed they wouldn't spend more than X, right? Putting us into a deficit more than a specific number provided in order to pass the budget reconciliation process. And to do that, they have had to pull back, right? Because now we're approaching that 10-year period where in order to say we only added X to the deficit, we indeed are pulling back on potential items that used to be beneficial, to be honest with you, for many middle and private family-owned businesses. So with all that being said, the only other thing I would like to point out is it's not as if, these pullbacks have just started. So if you're obviously working closely with your tax advisors, if you're in the 174 research and experimental expenditure space, it's been really painful, right? No one thought we would capitalize R&E expenditures, but here we are. and we continue to do so. In addition, bonus depreciation, right, is going down. We previously were at 100%. In 2023, we dropped to 80%. This year, dropping to 60%. And so that's a pullback, again, to make sure that we're meeting the requirements that were set upon us for budget reconciliation. And the last being interest expense limitation. We saw our ability to limit interest expense used to be based on, lack of a better term or general term, called EBITDA. So earnings before income tax, depreciation, and amortization. And now that has changed as well to be based on EBIT. So we no longer get to add back depreciation and amortization. So the taxable base in and of itself, before we even talk about the TCJA expiring provisions, is most likely growing, right? Because you're not taking 100% bonus. You aren't able to look at EBITDA, but only EBIT for interest expense limitation, et cetera. And so today, what we really want to do is kind of shift our focus to individuals and say, okay, we've talked a lot about pass-through entities. We've talked a lot about 199A, et cetera. Now let's talk about, some of the significant changes we might be seeing as we move forward. So I'm going to invite Jonah for our first question or explanation. So I think it's important for us to highlight, if the TCJA sunsets and there is no legislation that's passed, even if through budget reconciliation, what are the significant individual income tax provisions that will change because of the expiring sunsetting provisions?
Yeah, no, thanks, Lynn and Hal, for inviting me. Pleasure to be here. It's interesting. We knew this was coming, right? Since 2016, 2017, we knew it was on the horizon. And we sort of didn't really do much about it until we had a presidential election, right? And I think what every advisor, and certainly the tax team at Witham, is trying to do with our clients is planning for all scenarios and trying to model out all scenarios. You'll know that I love cliches, and the only thing that's certain is uncertainty, right? And to your point, no matter what happens in November, these provisions, because of the reconciliation process, at least the individual provisions and some of the estate provisions, are going to expire at midnight, December 31st, 2025. So it always tends to end up with the individual. We have all these wonderful permanent business and corporate provisions, but at the end of the day, business owners and taxpayers ultimately are going to care about their personal balance sheet and their wallet. And some of the most drastic changes are really around the rates. Since 2016, we've had 7 brackets. We've been afforded, I guess it came into effect, for the tax year of 2018. We've been afforded 7 brackets, with the highest marginal bracket being 37%, the lowest one being 10%, and then 35, 32, 24% for that. So really low rates. Still, potentially high amongst other, industrialized countries with a progressive system. But we're going to go back to the previous rates, where the highest rate was 39.6. And not even that is the other brackets get expanded. And what I mean by that is, whereas before, that 35% bracket was rather wide, now the 39.6% bracket gets a lot wider, that highest marginal rate. And that middle bracket of 33% almost encompasses 3 prior brackets in terms of the income thresholds, right? It covers the 35%, the 32%, and the 24% bracket based on income levels and whether you're a single taxpayer or a married taxpayer. And so ultimately what that means is everyone's taxes are going to go up, and you're going to get there a lot quicker. So that's one thing if we don't hear of anything.
Yeah. So let me just add to that, Jonah. I think it's really interesting when you can obviously go out and look, right, at the Congressional Budget Office's projections of what if the TCJA, or when the TCJA sunsets, what does it look like? And I think it clearly at this point that the C corporations in and of themselves are pretty much staying level, and the massive brunt of increased revenue for the federal government is indeed coming through individual income taxes and payroll taxes. So I just like to throw this out into the universe so that people are aware. But right now, the collection is around 6.1 trillion in 2023, and they're estimating for that to go up to 10 trillion in 2034. So that increase again is directly, you're seeing essentially an 82% increase between payroll taxes and individuals, again, because the C corporations are staying kind of stagnant. So that's one thing that's really important to your conversation. And what we always try to stress is don't get caught up as much in 37 going to 39.6, but you really raised a great point and saying, but the brackets could even be more important, right? Because now we have a 33% bracket starting much lower, below 300,000, and going all the way above 500,000, where before, that was in the 24 or 32% range.
Yeah, and it's not even that, and I'll get to the itemized deductions in a second, but there's almost, because of now you have the personal exemption limitation being reenacted, or coming back in, and then the piece limitation, which is a limitation on itemized deduction, there's almost this phantom 1.3% surcharge in effective rate for your highest marginal taxpayers. So really it's 39.6% plus another 1.3% for your high earners because of the limitation of the benefit. And guess what's coming back? We're going to see alternative minimum tax come into vogue again, right? We sort of had most middle income taxpayers had a reprieve from the AMT. And I guess for our listeners that aren't familiar, it's really a parallel tax system. Certain deductions which were previously allowed under sort of the normal tax system are disallowed under this alternative system. And there's an effective rate on the AMT of your AMT taxable income of anywhere between 26 and 28% blended. And the biggest deduction in AMT, which happens to coincide with your coastal states, which happens to coincide with your democratic states, is your state and local income taxes. That for those areas, for the coastal cities, that tends to be people's biggest deduction because property taxes are high. New York and California have the highest state and local income taxes in the union. So while taxpayers pre-TCJA received a federal benefit of deducting state and local income taxes, well, those are disallowed deductions for AMT taxes. So while people's federal tax, people think, oh, I'm going to be able to deduct my real estate taxes, my state and local taxes again, certainly, but it'll throw you back in to the AMT. And sort of the base academic understanding of who's affected by AMT taxes, well, guess what? It's folks that have a lot of capital gain income and a lot of people that have a lot of state and local income taxes. And guess what? Those traditionally are folks, your financial service professionals, your C-suite executives, your real estate professionals. The bulk of those taxpayers tend to live on the East Coast and the West Coast. So I'll let you talk about the political implications of that.
No, I was going to say, Jonah, though, I mean, I think that's one thing that, at least when I am listening and hearing and reading and talking about this, so many people are focused on 199A going away and 37 moving to 39.6, right? Those are very common themes. But the AMT theme is huge. So I just want to remind everyone, when the AMT, if this sunsets, as will occur if nothing happens, we essentially were granted a much larger AMT exemption amount, right? In 2023, that's about $1.1 million. Pre-TCJA, that was $160,000. And then that's the phase out, threshold amount. And then the exemption amount is up to 126 versus pre-TCJA 84,000. And really, at this point in time, not a lot of people are paying individual AMT because of those increased amounts in the phase out threshold and the exemption amount. But based on tax policy centers, they have essentially said we're going to have about 8 million more people fall into AMT by the time the TCJA expires, and they expect that to jump to 10 million by 2030. So really, it's a really big hit that, as you said, is commonly driven by state and local income taxes, charitable contributions, et cetera.
Yeah, that's really, it should be interesting, which I'll go back to how I started off. Modeling and scenario planning is really, really important because it may affect decision-making now, right? traditional tax planning years ago was defer income, accelerate expenses, right? Well, if rates are going up, then I want to recapture that income in a lower tax period. And then I may want to defer expenses out when I'm going to get a bigger effective and marginal benefit because the rates are going up, right? I may want to time the exercise of options or incentive stock options because I'm less likely to be an AMT. As we know, one of the sort of the catches for exercising incentive stock options is that spread, while not taxable for regular tax, is income for AMT taxes. And certainly that coupled with some of the itemized deductions, right? We just talked about the state and local income tax deduction, the $10,000 cap going away, but most likely AMT is going to happen. We also have things like mortgage interest limitation, right? Rates are also super, super high. Folks had 2-3% mortgages. That's sort of free money. We had $750,000 of home acquisition indebtedness where we could deduct that interest. It's now reverts to $1 million. Certainly home equity interest. Those employer expenses, and I'm doing air quotes for our listeners because most employees really don't get expenses, but those 2% deductions are now allowed to be deducted. Well, guess what? Those are also an adjustment for AMT purposes. So while you may get a benefit federally, it's going to throw most people to AMT.
And let's talk about, you went to a level of detail that I'm assuming some of our listeners have never heard of, right? So a lot of people might say, okay, well, at least I'm getting all these itemized deductions for my regular taxable income. But there's this nasty correction through the P's limitation that oftentimes can take a significant amount of itemized deductions away. Can you explain that?
Yeah, so the P's limitation is basically if you're maxing out your itemized deductions, there's about a 3% reduction of those over a certain threshold. And let me just want to check what that limitation is. So I think for the P's limitation, it was, and you'll have to correct me if I'm wrong. I think it's for married filing jointly. It's the phase out is for income over $395,000, and so there's a 3% haircut, itemized deductions for married taxpayers for that. And then just sort of doing the math, that 3% reduction adds about 1 to 1.3% of tax because of the reduction. And so you take the P's limitation and the reduction of personal exemptions, and I guess I'm going ahead of myself, right? TCJA suspended personal exemptions. So for yourself, your spouse, your children, those come back, allowing taxpayers to claim personal exemptions for themselves and their dependents. Well, guess what? This personal exemption limitation or the PEP exemption gets limited as well. So those two things, while on the surface, it's great that it's coming back, but most moderate to high income taxpayers are still going to have a haircut and an additional tax, this surcharge on these deductions added to their tax return, which most people aren't thinking about.
Yeah, I think, Jonah, what I would say is if you're sitting here saying, wait, what? Yes, it's not a back of the napkin calculation we're making when we talk about TCJA expiring. We've highlighted the increased tax rate and the change in brackets. You've highlighted, yes, you might be able now to take all your state and local income taxes and move to an itemized deduction, but you have the P's limitation to deal with. And then that AMT, which was always there prior to TCJA, will likely be there again. And so there's a lot of factors that you need to take into account when trying to estimate what will this really do to your individual income tax return. I want to move on and talk about what do we know right now today? And obviously the vice presidential debate is coming up, but what do we know about what President Trump or presidential candidate Kamala Harris might be thinking of doing in this segment? Meaning, if they don't allow all the TCJA to expire, has either party indicated their intention of working through these specific individually focused items?
Yeah, great question. And if anyone is just opening up a web browser or a news channel, this is sort of all that's being published and talked about. And I would say we actually know a lot more from what former President Trump has been discussing, because I think for years there's been a lot of conversation about making permanent some of these provisions. And I think what we do know is a Trump presidency would probably aim to extend all the individual provisions from the Tax Cuts and Jobs Act, which was signed into law during his presidency. And as you mentioned, because of that reconciliation process and for the budgetary constraints, we had to have a time period on them. So he would propose making all those permanent. So keeping sort of the rates down, the $10,000 SALT cap, the elimination of the exemption, things like that. Basically, no change of how it is today. Additionally, there's been some discussions, and while we went from a 35% corporate rate down to a 21%, he's even discussed going from 21%, so I think even down to 15%, which is kind of interesting because I think you'll talk about, or I'm not sure we're talking about 199A now, and you may have done it earlier, but that qualified business, that 20% deduction brought an effective rate down to 29.6% to sort of make it pari passu with the corporate rate. Well, maybe all that planning needs to get rethought about if we have even lower corporate rates. Maybe a different legal form might be benefit. Again, Trump has talked about restoring the SALT deduction without a cap. I think it's sort of been talked about, but beyond that, there's not much. In terms of what Vice President Kamala Harris is, I think more of a selective extension of the Tax Cuts and Jobs Act. I think Vice President favors extending the tax cuts for lower and middle class taxpayers, which has been talked about, but would let certain provisions for taxpayers earning over $400,000 a year expire. It would revert the top rate on income to 39.6 from its current 37%. So that's been discussed about. The big one also is certainly capital gains rates and capital gains taxes. She proposes 28% plus, I think, moving the 3.8% net investment income tax to 5% for those with income over, I think, about $1 million. That would be a 33% or almost an ordinary rate for taxes for capital gains, which is even different from a President Biden's earlier suggestion of taxing capital gains as ordinary income.
I think you're right, and I would agree with you. The policy that's been put out there is broad, right? So it's like it could or couldn't, right? We're not quite as positive. For example, I've heard the C corporation tax rate may be reduced to 20% by the Republicans, and some saying it should go up to 28% by the Democrats. And I think overall, you're right that this goes back to if you had a crystal ball. We're reiterating to everybody, don't do anything now, right? Until we know more about where these plans are going to lie. But more importantly, understand them and at least start working with your business advisors, such as you and Hal, to know what type of levers we might want to pull down on come December, right? If we're unclear on what really could happen in 2025. So the recognition of income versus deductions and the timing is going to be have at least a clearer picture once the November elections are done. Those were all great points. And the one item I like to bring up, and this came up in some earlier discussions, is that capital gains rate. When you talked about, they might be going, our normal is a top rate is 20% plus 3.8, and they're saying, well, maybe we'll go up to 28% and raise the 3.8. For anybody of our listeners who are invested in qualified opportunity funds, this is something you're going to want to monitor, right? Because whether or not you actually dispose of the property or your investment in 2026, there's a fictitious gain that's going to have to be recognized in 2026. And just like they say, whether that gain is long-term or short-term is depending on what it was when you originally sold the asset in which you deferred the gain. They're also going to say the tax rate that applies in 2026 is going to be the tax rate that exists in 2026, meaning I can't go back and say, well, when I deferred the gain, I was only paying 23.8, but now I'm paying 30. That's not the case. So I always like to bring that up, not because there's anything you can do much about it, right? But in general, just to be aware. And if you're not seeing tons of benefit, or you're not going to look to hold that off for the long term, maybe you do sell that investment earlier than anticipated.
Yeah,
But
I mean, what you said is spot on, and I'm sure Hal will even reiterate it. Is now yesterday was the time to do planning, right? There's so many interrelated provisions that could come into play in terms of legal form, rates, deductions, credits. It's really a complicated calculus where our clients really need to understand the potential ramifications on what may or may not happen, just so we could pivot when we need to. So yeah, all good points.
Yeah. So speaking of that, Hal, I would agree with Jonah that planning, especially around estate and gift planning, should have already started to occur, if not. But I guess I would propose to you, again, not focusing on potential presidential candidates' policy. If the Tax Cut and Jobs Act expires, what is going to essentially happen for people in the estate and gift tax arena? And how might that impact their current planning?
So, how Tax Cuts and Jobs Acts apply to estate and gift exemption. Prior to 2018, the estate and gift exemption was $5 million, indexing for inflation back to 2012. And the 2018 Tax Act basically doubled that exemption to $10 million indexed for inflation. So currently, each high net worth individual has an exemption of $13.61 million exemption. If no legislation is passed by December 31st, 2025, the exemption does go back down to that $5 million index for inflation, which we estimate to be about $7 to $7.5 million. Why it's important to start the planning now is because the IRS came out with regulations that said there would be no clawback of the additional estate and gift exemption. Meaning, if an individual used that increased exemption while it was, in this example, 13.6 million, and then it dropped down to $7.5 million, the IRS would not say, come, we want your estate tax or gift tax on that additional $6 million. What's also important is how the estate and gift exemption work, because the misconception is that individual thinks it goes from top down, where it's really from bottom up. And how I explain this to clients is, if I have an individual who's worth $20 million and gives away $13 million today, and in 2026, the exemption drops to $7 million and passes away, well, what's left in his estate? 20 minus 13 is $7 million. What's the available exemption? It's 7 million less 13. Can't go below zero, so zero. So that individual's taxable estate is 7. Conversely, the same individual who's worth 20 million only gives away $7 million. Now they're left with 13. Again, unfortunately, the client passes away in 2026. Well, they have 13 million in their estate, the $7 million exemption, but they use 7. So now they're still back at 0. So now their taxable estate is 13 million. So to take advantage of this increased estate and gift exemption before it sunsets, individuals have to consider making more than $7 million of gifts.
Mm-hmm. Mm-hmm.
So that's important. And where we're talking to clients, it also depends on their net worth, the excess capital they have available for gifting, and the impact to their overall estate plan. Generally, if a client's worth, say, $50 million or more, it's a no-brainer. Use the increased exemption now, because if it goes back down, you didn't lose it. Conversely, client worth 15 million or lower, if they're married, probably not going to do much in form of gifting. because when you gift assets, it's carryover basis, meaning whatever the individual's basis becomes the child's or the trust basis in the asset. Versus if you inherit a property, you get right now
Right.
under current law step up in basis.
That's a great point, Hal. And so
So
I'm gonna go back on two things. So what I gleaned from that is right now, if you it's appropriate, and that's a great point. We got to make sure it makes sense for us to engage in this type of planning. But to the extent you have, for example, you said 50 million in an estate, there's ability to shelter 26.2 million. Versus if we revert to the inflation expected amounts after the TCJA sunsets, we're only looking at being able to displace 14 or 18 million. And so that delta is really what they're subjecting themselves to at the high estate tax rate. But so that's one. That's what we're really trying to pull down on individuals. And I guess my first follow up question would be: do you sometimes see from a married filing joint couples, if they don't have a $50 million estate, is there still a play to have the husband or wife use their full?
so
Yep.
if you're between that 26 and 50 million, or you're looking at it, what I tell clients to take is called one bite of the apple. Use one spouse's full exemption at 13, and then you keep the other spouse's exemption at 7.5 million with powder dry to make gifts in the future. But again, it all depends on client's lifestyle and what's their comfort about giving away assets and giving away money to the next generation. But so if you're in that in between, maybe you use one spouse's exemption. A typical structure is through a spousal lifetime access trust, where one spouse creates a trust for the benefit of the other spouse plus children, using up the exemption, freezing their estate. But as long as the donee spouse is alive, then both individuals have access to the money. Assuming two things: you want to be nice to that donee spouse, because if you get divorced, you lose the access to the funds. And then also, you're going to want to make sure that donee spouse eats their spinach, because if, God forbid, they predecease you, again, you lose access to that money.
Yeah, I love that, and that's you gotta make sure there's no divorce or death that's impeding within the next couple of years. But then so you also talk about another point, and it has to do with basis, and this has been a lot of discussion, and maybe we're bleeding into more topics we're supposed to cover in the future. But when you talk about, I would say if I'm gifting, so let's say assuming, I don't know, I have a building, and my basis in my building is 200,000, but the value now is in a highly appreciable area is worth 1.5 million. If I gift that, right, you raise, which is very important to understand the difference, that the person who received the gift, they would only have a basis in the property they received of 200,000, a carryover. They take the same basis as the person who provided them the gift. However, with receiving property upon death, in that same example where we said the basis was 200,000 and the fair market value was 1.5 million, the recipient at death would be able to receive a $1.5 million basis. There's been discussion about that, though, and I'm not just saying, it's not even within the presidential campaigns. There was discussions about that particular item, and the Build Back America Act that was up by the Democrats. I think it was 2 or 3 years ago. But how would that, if that would occur, meaning you no longer received a step up in basis upon death, how would that impact the same gift and estate planning that we're talking about today?
Well, if there is no step up in basis, then and you're only subject to estate tax, then that doesn't come into play, and you would gift the asset. But we've been down this road before with no step up in basis in the early 70s, and it didn't work back then, and I perceive it won't work back now. There have been proposals where there would be no basis for individuals over estates over 5 million marrying jointly of 10 million. also remember we did have 1 year when there was no step up in basis in 2010, where we were under the alternative estate tax system, where individuals got 1.3 basis step up, 3 million to spouses, but that was only in 1 year under former President Bush. But but it is very important to consider right now where the current law is with the basis step up, because you do hear a lot of people, you got to make gifts, before the exemption goes away, and they're overlooking one tax, the step up in basis in a capital gains tax versus another tax for estate tax purposes. And so those clients that are somewhat moderately wealthy, 15 million to 25 million, that's where possibly life insurance through a second to die life insurance trust may make sense for clients to retain control of their assets, to maintain that step up in basis at death, but also then provide liquidity outside of one's estate for the replacement of wealth for estate taxes if the
So
exemption
I'm
does
going to
go down.
repeat that, Hal, because that's a fun planning opportunity, right? That a lot of our listeners could be in. And when you think about your balance sheet, I would just say to all our listeners, and I know you all know this, but just as a reminder, it's not just what's in your bank account, right, or your investment account, right? It could be the stock of your privately owned company, right? And it could be real estate. It could be entertain a lot of different items when they're saying, what is you, the taxpayer, married filing joint couples, value for purposes of getting involved in and really planning. And so Hal said, if you're not at that 50 million, which is kind of a sweet spot to full-fledged do estate planning the traditional way, he mentioned, well, if you're between 15 and 20, there is a planning mechanism that we can still use the higher exemption amounts that are being provided currently, while not impacting your cash flow or your capital flow through the use of insurance. So I would just anything to add to that, Hal, but I really want to highlight that because some people just say, well, I'm only 15 million, so I'm not getting involved.
Yeah, well, the 50 millions today, hopefully there's growth of assets that could be in the future. So,
Right.
and that insurance gives some flexibility down the road.
Perfect. Okay. So we're going to keep moving forward and ask, do either presidential candidates talk about this exemption amount and discuss how they might alter or how they would want their tax policy to be regarding these two plans?
Well, as Jonah mentioned, former President Trump's proposal is to make Tax Cuts and Jobs Act permanent. So then the increased exemption, currently 13.6 million, would go beyond 2025. While Vice President Harris has not really formally made any estate and gift proposals, she did endorse the American Housing and Economic Mobility Act of 2024. This was a progressive proposal where would decrease the estate and gift exemption back down to 3.5 million, which was the exemption back in 2009, increase estate exemptions beyond 40% up to 55%, and even indexing it, even charging a surtax at 10% on taxable estates over $1 billion. But that is one of the Democratic progressive proposals. The other item is to look at is under President Biden's Green Book proposals, which was the reduction of using certain estate planning techniques or gift planning techniques, such as grantor trusts, grantor retained annuity trusts, and reducing the ability of using discounts for lack of marketability and control for gifting of business assets. So that has to be considered under Vice President Harris's proposals for under the state gift tax laws.
Right. So you bring up so there's a lot there, I would say. And again, I always caveat that we're projecting based on previous policy of Biden, previous support. Vice President Kamala Harris on previous bills, because there is no set policy at this point in time that has been issued regarding these items. But one of the things you brought up was the applicability of discounts or minority positions when valuing what can or can't, or valuing what would be transferred. So tell me currently how people, what does that mean, a minority discount, and how could that positively or negatively affect people if that ability to value that way goes away?
So certain things are very easy to value. Stocks on a tradable securities market, say IBM stock. You can know what that value of that stock is on any given day. But other assets, such as a closely held business or a piece of real estate, is not easily tradable. So for gifting purposes, you can value those type of entities and take discounts for either lack of marketability, because it's not a tradable market, or lack of control. And we can structure companies either with voting and non-voting stock or limited and general membership interest. I can give away value but not control, and sometimes individuals can get a discount anywhere from 20 to 40%. So it's a way to leverage the use of one's gift exemption to get more value outside of one's estate.
Yeah. Yeah. And so I would say we see that a lot, at least I've seen a lot, when you have a private company, right? Because it isn't publicly traded. It's not a readily ascertainable value. And so to the extent that you're involved, right, in such companies, it makes a lot of sense to review that, especially knowing that, that could be, again, based on prior support of different parties, could be on the table for elimination. So I think that's a good one that's oftentimes used in this space that would have a dramatic impact, right, if we're no longer able to utilize it or assess that minority discount. Okay, so that has been great. So that's kind of the minority discount was one thing I wanted to talk about because it's a pretty standard usage and in this space of valuing property. And the other topic that has come up. Right. I'm going to give a little bit background. We originally, if you remember, Senator Warren had talked about something called a unrealized appreciation or mark-to-market tax. And that had originally come up 2 or 3 years ago with the Build Back Better plan. It didn't ultimately get included, but we have seen even as recently as this week that the Senate Finance Committee leader, Senator Wyden, has started popularizing, speaking to that potential unrealized appreciation and the taxation of it. So I just want to, I'll give an example, and then I'll let Jonah and Hal jump in. But essentially, if I'm sitting with property, right, the argument is, in my same example I previously gave earlier, if it has a basis of $200,000 but it's worth $1.5 million, I essentially don't get taxed on that appreciation or that $1.3 million unless I dispose of it. And so there's arguments out there that say, well, wait, that person, right, does have access to liquidity. In that example, they have access to 1.3 million of liquidity in which they could go and get some type of loan with providing that building as collateral. And so the question then becomes, the first question becomes is that correct? Should we not tax unrealized gains? So that's my first example with property. My second example would be with stock, right? So everyone always likes to point out Elon Musk. He has a significant amount of value for the companies that he owns, but doesn't necessarily get taxed on that because he doesn't dispose of it. He leverages it, right? He goes out and he obtains cash to move forward and do other things because of the unrealized value within that stock. So I'm going to open it up to now saying that's the general terminology. And do you have any insight on how this could affect your clients, or have you ever operated in a state before that has launched this unrealized taxation. And I would point out the U.S. is not, creating the wheel here. Many European countries have already explored implementing a wealth tax, and there's a lot of historical data on that. But I want to kind of focus now more to Jonah and Hal on their thoughts on, what that might look like if that should come to fruition.
Yeah, I love how you left the most complicated and controversial topic for the end, where we could spend all day long talk. And I've said this before. There's a reason why economists don't run for president, right? So this sounds great. I mean, it sounds sexy, and we're going to equalize the system. We have a real progressive system in the United States, but the Tax Foundation and Tax Policy Center actually, this doesn't really work, right? And in reality, it affects such a small percentage of taxpayers in the United States. This billionaires tax, if so, the amount of revenue it's going to generate really is not significant, right? Now, on the flip side, as tax practitioners, Hal and I love complexity, right? We love when there's nuance and esoteric provisions, because it keeps us gainfully employed and it keeps things thought-provoking. But if anything, it gives opportunity for us to really advise our clients on sort of what happens. So, I personally, and these are not Witham's views, these are sort of my own personal views. I don't particularly think this really works in practice. Implementation is going to be very, very difficult. Tracking is going to be very, very difficult. You have the concept of, well, what if the value of that asset goes down in the future? What if there's other M&A transactions that involve these assets? It doesn't really address wealth inequality really, really well, and it doesn't really raise revenue all that well. Hal talked about valuation before, right, with gifting. Well, this creates valuation complexity, right? If now you have privately held businesses and you have stock market and stock market volatility, well, maybe this sort of surtax at 25% changes market equilibrium, right? Changes potential transactions, right? It also creates liquidity issues, right? If you have a client now that has all their positions in closely held concentrated stock, well, they may have a double burden, because they may need to liquidate positions to generate the cash needed to pay the surtax. And now they've been talking about, you have 9 years and 5 years to sort of pay it out over time, and you get a credit, but then you also have the time value of money issue. And again, it sounds nice. It's going to be a rally cry for certain people. You're not going to have enough votes, I think, in either system here to pass it. To be honest,
I think you raise a great point about conceptually what it looks like, and then administratively, right? We're accountants, and so we're like, hey, the conceptual is for some higher pay grade, but we are the ones who are ultimately, putting our license and signing the tax return and making sure we feel comfortable that we're meeting this to the best of our ability. And so I just want to point out some things that you highlighted. So when you hear people talking about this, one is like, what threshold will it apply to? But to your point, Jonah, is if you're on the cusp of that, right, you're not up to, and it could be whatever threshold they choose to, you still might have to be involved in valuations, et cetera, right, in order to determine whether you are or you aren't. The second piece, which I think is really interesting, is the pure valuation. So if any of you have been involved with valuation, which obviously Jonah and Hal have been quite a bit, is, there's a level of gray there. And so there is concern that, how something is valued could drastically be different from company A valuation versus company B. And then lastly, I think to your point, when European countries have tried to implement similar systems, the overall revenue they've gotten it was 1% or less. It's a very small amount of revenue of the overall budget. And they have seen high net worth individuals look to locate in other places that they don't have that. Now, moving from Spain to Portugal, is probably not as different as moving from, the US to Canada, but meaning, just geographically, right? Not as much space in between. But again, there ultimately is that fear. And so I would just, yep.
You mentioned Spain. Some unintended consequence of this as well is, we potentially it's not going to affect foreign investors, but only U.S. investors. So now there's sort of an incentive for foreign investors to sort of move money into the United States. Additionally, what could this potentially do? We don't know, to maybe cull domestic investment and capital investment. If now there's going to be these surtaxes, that might actually slow down economic growth potentially, because now potentially a high net worth taxpayer might think twice where they're putting their dollars, because there's going to be this surcharge almost penalizing them on their investment. So there's a lot of things that it sounds great. Same thing with the estate tax. It only impacts a very small percentage of people in the United States, but it sounds great.
Mm-hmm, mm-hmm. Hal, any comments you want to share?
I think, as you said, politicians are not economists. It could be a good talking point. However, I don't see how constitutionally they would be able to pass a wealth tax. It's hard enough to pass tax bills without going through reconciliation. Doing a constitutional amendment is another item. You had previously where there was a technique which was called short against the box, where a person had a long position and a short position and then borrowed against it, and they took that away. There's other ways to change the tax law for the quote perceived abuses of borrowing money against high value positions, where that can be taxed versus implementing a wealth tax.
Yes, that's a great point. So thinking outside the box, right? And it's not only just with the Tax Cut and Jobs Act, and as you said, there's other ways to get the taxation on high net worth individuals that might fall into that unrealized taxation concept. But that is a focus that I try to bring up in all my podcasts is we really need to make sure that the discussion isn't on things we've already talked about, right? And so it's always dangerous when someone brings up a new concept like this unrealized tax, because then it kind of stays with us as we progress and we continue to evaluate where tax reform should go. But there are a lot of things out there that can be evaluated for tax revenue raisers, and it doesn't have to be focused on 199A or 39.6% rate, right? There are a variety of different items that could be scored. For example, the common one that's always scored and hasn't changed is the carried interest. But I'm hoping that those will come to light in the process of federal tax reform. So as we wrap up, you are truly sitting with two specialists today and our firm, highly regarded. And I'm going to have them offer you a piece of free advice by saying, what should individuals and high net worth clients be doing right now to assess, how they're going to enter into the 2025 taxable year?
Well, for the estate and trust provisions, what I'm telling clients right now is look at what their current net worth is, understand what their estate goals and objectives are, and then be educated of the different alternatives that are available. Reach out to an attorney to get their, estate documents in order. You can create trusts and not fund them. And this way, depending on what the election occurs, then you can start funding them. Going out and trying to get in touch with an attorney after November 2024 may be difficult.
And I'm just going to re-highlight that because that's been a focus on all of these podcasts is tax planning for estate planning should have already started to occur. And I think I would just highlight what Hal said and the fact that you can create the trust. It doesn't mean you're necessarily going to use the trust at this point in time. But similar to what we saw under the Build Back Better plan before we knew where Manchin and Sinema were going to end on the vote, you couldn't engage an attorney in the estate in the estate practice, come December 1st. we're seeing that most likely with the TCJA expiring, start planning now, be finished by the first 3 months of 2025, because there really is going to be just a lack of availability for good advisors to assist you. So I think those are both great points, and appreciate you sharing. Jonah?
Yeah, no, I think to your point, early and often on the individual side, there's a case for scenario modeling for different clients. Just again, if sunset happens, if it doesn't happen, if there's a vice presidential plan that comes through, if there's an extension, there are decisions to be made and the calculus is not easy, because there's credits and exemptions and incentives and different brackets and different deductions and as Hal mentioned, insurance scenarios and estate and gifting scenarios. All these things are interrelated. If I'm a different legal form and if the corporate rates, what am I left with after tax, right? And so it is interrelated. And for certain taxpayers in that sort of that middle area, it behooves us all to really be as proactive as possible to try to educate our clients with what may or may not happen. And I don't want to spend anyone's money, but it's certainly money well spent if it's going to make you educated and make you nimble enough to make a decision when it's time to make a decision.
Right. And I would so 2 things I want to highlight. You could be wanting to make a decision come December, right? You really could. And the fact that you accelerating income or deferring income. But the other item I would put together, and I think you spoke well about it, Jonah, is this is transition planning, right? It is not, I know this subject, especially with the states, can sometimes be taken aback. Well, I'm not dying anytime soon. Well, that's not the only thing that's the focus on in this, right? Like if you have a large private family owned business, and you're wanting to transition out, are you going to transition within family members? Are you going to look for outside family members? How are you going to make it liquid? What are you going to do with that liquidity and for investment? There's just a really round table. I would say, 4 to 5 different business advisors in the room tax advisors, I should say, when trying to put together a transition plan. And so you would be shockingly surprised how many people haven't evaluated it. Of course, because oftentimes it's, the low prioritized because of everything else that's been going on, whether it be COVID, supply chain issues, et cetera, et cetera. So, but this is time, hopefully, where you're being able to take a breath and realize, what, even though that might be 20 years away, I should probably at least have a conversation about it. So appreciate Jonah and Hal's time today. Great experts. Again, don't hesitate to reach out to them if you have any additional follow-up questions, or obviously myself. We're excited to be able to share this thought process with you. This is what many accounting firms are going through right now. And again, the single most important piece is education of our clients and our future clients to know that we are aligned with you, we're here with you, and by working together, we can definitely plan accordingly and get to a better place. So thanks so much. Any closing comments, Jonah or Hal?
No,
No?
I'm good.
Okay. Thanks, everyone.
You've been listening to Withum's Tax and Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.withum.com for additional information. Send an email to info@withum.com or follow us on Facebook, Instagram, or Twitter @WithumCPA. Thank you for listening.